Hey everyone, thanks for being here today. I really appreciate your time and the ability to be able to speak with you a little bit about what's going on in the market regarding first-time home buyers and student loans and how much student loans really affect first-time home buyers and honestly the market at large. Uh, Before I get into this too much, I do want to just cover briefly who I am. So my name is Nathan Jennison. I'm the founder and managing broker of the Mortgage Architects. That company helps customers get into homes and solves problems that many other lenders can't. And we also help real estate agents be more successful and to grow their business. We are an independent mortgage broker. We have access to 35 plus lenders that are on the wholesale side that compete for the customer's loan. We are always working to match the right lender to the customer and the one that has the best value with the best match. So it is not a one size fits all um, situation as it is with many loan originators who only have one source for their loans. We have offices in Chicago and Denver. We also are opening another office in St. Louis, so we have an expanding footprint. I've been in the Chicago area since 1998. I also have a home in Denver. Really focus on being the industry leading in customer experience. And so, what that really means is that we're focused on the experience that the customer has in the midst of getting a loan from start to finish. There's a lot of anxiety in that process, particularly for first time home buyers. And so we take an excessive might not be the right word, but we take as much time as necessary to talk with customers, address any and all questions, concerns, anxieties that they have. We make ourselves available off hours, even nights and weekends. Because reality is sometimes a customer has a question that they're really anxious about. I can take 10 minutes of my time to respond to a text at 7 o'clock at night, and they're going to sleep well, especially true on a Friday, on a Friday afternoon, evening. We don't want them to be anxious all weekend. When the reality is, I can probably pretty quickly set some of those fears at rest and help move them forward. So that act of being available is not nearly as common in this industry as it really should be. And the other part of it too is of that experience is how we work with agents. So there's nothing worse than being a real estate agent on a purchase transaction and you get a call from a listing agent who's really upset, hot about some development in the deal, and you're not aware of what's going on. You're in the dark. And then you're in a situation in which you have a loan officer that you can't connect with, that doesn't return your calls, that takes days on end to answer questions that you have, then that leaves you in a situation of basically trying to address a listing agent and not let on that you don't know what's going on, and that puts you in a very, very awkward situation. So throughout the process, we are communicating with you as a listing agent. We're making sure that you are aware of the steps of the loan, where we're at. You get every Friday, you get an update from us, even about the referrals that you have sent our way and where they're at in the pre-approval process. So the reality is the customer who is purchasing the house is not our only customer. Our other customer is yourself. We want to make sure that you're having as smooth an experience with us as you will have experience you have elsewhere. And that's what we go for each and every time. The other thing that's really important is that there are problems that show up in the loan process. Like some of them are unavoidable that we won't know about them necessarily going into it, and things pop up. So any loan officer who promises that you will never have that experience is not telling you the truth. But the reality is many loan officers, because they're trying to hold themselves to a standard of, hey, there is no problem. We're going to find a way to fix it. We're not going to communicate it. A lot of times what happens is they put their head in the sand and they avoid the issue. And then everybody finds out about it a few days before closing, sometimes right before closing, that all of a sudden there's not a deal. And the impact of that is massive, not only to yourself, to the listing agent, but also all the families that are involved. So when we hit a problem, if we don't have an immediate solution for that problem, guess what? I'm calling you and I'm talking you through it. And the reason why is because we're a team. We work together to get the customer into that home and to solve problems. And that's from the very beginning when I'm supporting the offer with the listing agent. So when there's problems, you're going to know about it because I'm going to call you. And if it's something that we've done wrong, we take ownership of it. So that's a whole different experience than what is typical in this industry. So that's kind of where we're at from there. Also, just on a side note, I am actually an owner of two businesses, not only the Mortgage Architects, but another company called the Independent Mortgage Brokers. And that is a company that I own with another partner called Ryan Davis. And we essentially created a company that we wanted to work for. We made that available to other loan officers. So this is the larger company that holds our licensure and our portfolio of lenders, and essentially is growing very quickly. At this point, we have around 40 loan officers. We have about another 10 that are currently onboarding. So it's great, but it is actually the engine behind the mortgage architects, and because I am an owner of it, it gives me a little bit more added influence as far as regarding, hey, if we need a particular lender to be able to get some jobs done because we can't, we have a hole, and for whatever reason we can't help those customers that are in that fall into that bracket, we have the ability to go after it and be able to make that happen. So that's really key. All right. Well, without belaboring any more about that, that's a little bit about who I am. If you have questions, again, feel free to reach out. We very much care about the relational aspect of what we do, not just, it's not transactional. Like that's something we don't want to get into. All right. And moving forward, I think if I can move the slide to the next slide here. There we go. No, there we go. All right. First time home buyers. So, and student loans. So, the reason these may not seem like they go hand in hand, but the reality is that they very much do. So, the reality, first-time homebuyers are in a situation in which they're in a really tough market and they don't have the same resources that a lot of other potential buyers have, especially in terms of equity and ability to basically manage things such as appraisal gaps, low inventory, etc. So, and student loans has a big impact on that, which I want to get into here. All right, so what we're going to talk about, we're going to talk about ways in which you can get ahead of the competition, especially in terms of other first-time homebuyers, how to reduce the monthly costs of your first-time homebuyer. That has a really big effect because the reality is, even if they don't purchase a house, if we lower the amount that they have to pay on a monthly basis, that will allow them a little more breathing room, less anxiety in terms of their budget. So that's an important aspect. We're also going to increase their approval range. And that means a ton because a lot of first-time homebuyers are scrapping everything together just to try to reach that first rung on the housing and real estate ladder. So this is going to help them do that. And of course, with a higher approval range comes higher commission checks. So the reality is that everybody wins in this scenario, and that's how we do business. All right, let's talk a little bit about the market. So you're looking at the home vacancy rate in the US. This is government data. You can find this on the St. Louis Fed. And this is essentially what I'm going to do is I'm going to show you what's going on in the market in two slides. There's a lot of complexity out there. A lot of people are saying a lot of different things, but there's two main drivers of this market. It's supply and demand. So let's take a look at supply. So if you're looking at home vacancy rates, what that means is homes that don't have anybody living in them. When a first-time home buyer is going to purchase a home, they have to be able to move into it, which means it has to be vacant. So what you're seeing here across the board is that all the way up until about 2005, we had a pretty consistently level vacancy rate. In about 2005, we see that builders start delivering housing to market at ridiculous rates. And the general population had come to understand that you can't lose with real estate. And so as fast as builders were delivering housing to market, there was somebody that was purchasing it. In my industry, of course, we were happy to serve up loans to anybody that could fog a mirror. And so we all know how this ends badly, right? So we have the market collapse, the bubble bursts. We have a ton of housing that is vacant, that's sitting. A lot of it's not even finished. And so what happens is builders get burned big time. And so we peak here in 2008. Many builders went out of business. The ones that survived lost massive amounts of money because they had a lot of houses inventory sitting there not being purchased and falling in value. And so the end result of that is that builders pulled back. They didn't build at the same rate as they had before. And in the meantime, from 2008 to 2022, we added approximately 30 million people to the population. So we have a ski slope down regarding home vacancy rates until we hit an all-time low. So that's really important. We have very little supply. Now, a lot of people are thinking, hey, builders can quickly fix the problem that we have. They just need to build housing more quickly. And everybody talks about the fact that like everywhere they look, they see homes going up. So clearly builders are really building really fast, and they want to do so because obviously there's more money to be made. However, that's not exactly true. So there's a couple things going on here. First off, builders have a very difficult time building at the pace we need because of labor. So skilled labor, so we're talking about plumbers, electricians, etc. In the US, the average age of them is between 50 to 55. For every three that retire, one replaces them. So that makes labor and the cost of labor go up pretty dramatically. And then the other part of it is that there's not a lot of incentive for them to be building at a fast rate because the costs have gone up for supplies. So the homes that they are delivering to the middle of the middle class to the upper middle class, and that has shrunk as far as the what price range the upper middle class can afford. All of that has been constricted into a more narrow part of the housing industry. And so homes that are delivering there, they don't want to build at a really fast pace because they want to keep their margins high. They don't want to be like struggling in terms of labor and then have housing that sits on the market. So because there is a excessive demand, they know that they can sell it pretty quickly and they can make money what they need to and they can just keep plodding along on that pace. What's interesting is that they're actually falling behind about 500,000 to 600,000 homes per year. So if we look at new household formations, which basically every time a new household is created, it has to live somewhere. Then if you look at that rate versus the build rate, that's the difference. They're falling behind significantly. And if you look, depending on where you're getting your information, we are between 4 to 7 million homes short in the US as of the beginning of 2023. So this is a problem that is significant and it's getting worse. And there's really no light at the end of the tunnel. We don't know when we're going to actually see this balance. And let me show you why. Let's take a look at the other side of it, the demand. All right, so this is not a very pretty graph, but it is really insightful of what's going on. So this is the US population broken down by age, literally year by year. And if you're looking at this, one of the important things to know is that in 2022, the average age of the first-time home buyer was 36. So if you look at where 36 is, that's right here. So why is that important? Well, take a look at what's coming. We have the largest number of first-time homebuyers that we have ever had in this country for about the next 10 to 15 years. At that point, so people who are 2021 right now, they basically mark like the end mark where basically that population there starts to be a little bit of a population decline. And then on top of it, you're going to have baby boomers that are also starting to kind of age out. So in about 10 to 15 years, we may see some shift in terms of the demand side of the equation. Now, why is this so important? Well, keep in mind that many of the people that are at this first time home buying age have not purchased. And the reason why they have not purchased is because for all of 2022, they saw crazy headlines about a 20 to 30% market collapse that was impending, that was going to come, that was like doom and gloom. It was the worst time to buy a house, according to everything that we saw in the media. And first time home buyer sentiment was the amongst the worst we'd ever seen it. And then in the midst of that, we saw interest rates spiking like crazy. And so then we hit sevens, and then this year we hit eights. And that is just causing a more and more fear. And so the reality is many of them were either priced out of the market, they couldn't afford it, or they were too scared to purchase. And the majority of people that you talk to right now say, hey, I want to buy a home, or of those that you actually want to buy a home, hey, I want to buy a home, but I'm not going to buy right now because buying a home with a high interest rate, that's just stupid. Why would anybody ever do that? And the reality is that they don't understand what's happening and they don't understand how now is actually the very best time to buy a home in terms of looking at what's going to come when everybody does the same thing. So think about it this way. If we already have very low supply as it is with high interest rates, with fewer people out shopping right now, then what that means is that sellers are more likely to give seller concessions. They're more willing um, to negotiate with somebody who wants to purchase their home because there's not as many people out there to sell their home to. Now, when interest rates come down, are there going to be more or less people in the market? Well, the obvious answer is there's going to be a whole lot more people in the market. They're all going to have the same trigger. Rates come down. Oh my gosh, I need to buy. They all jump in. Well, they all start chasing the homes that are available. And we know that builders are not delivering a whole lot more homes any faster than they currently are. So what happens in that situation? If there's not homes to move into that are vacant, the prices are going to go up. There's going to be excessive competition for homes that are move-in ready. So in that situation, it is going to become suddenly much more costly for people who are buying to be able to get those homes under contract. And on top of it, sellers that are willing to negotiate at that situation, that evaporates. They don't have to negotiate. They can just pick the highest offer with the highest appraisal gap. And so what happens then is that we have a very different situation, which is honestly what we saw last spring, which we had the same thing, even though the National Association of Realtors was saying that we would have 0% appreciation for 2023. What we're seeing is that at the end of this year, we're going to finish probably somewhere between 6 to 8% appreciation, which is way more than the national historical average. And the reason why is it comes down to very simply supply and demand. And so first time home buyers are the ones who are going to be the least able, the least prepared, have the least resources to navigate those dynamics well. And again, this is why they need to be purchasing right now. It's also where student loans come into play. Because guess what? First-time home buyers have a higher percentage of student loans than other home buyers who potentially have paid them off. But even so, what has happened with student loans is that as of October, they started to have to be repaid. Sorry, I just didn't cover this slide. So basically, again, this covers everything that we just said: a pent-up demand, low inventory, low vacancies, and that really becomes a buying crisis for the customer. All right, let's talk about a true story: student loans. So student loans started having to be repaid in October, and this is not something I personally know, but a friend of mine knows this person. So she's a psychologist. She's working for the county, so she's working for government, and she has 300,000 in student loans. And so, in the midst of hearing that payments were going to come due in October, she panicked. And so she saw an ad for student loan consolidation and she jumped on it. It had a low interest rate of 4.4%. And this was the obvious smart thing to do because she was in trouble. And so she did not know that this company was actually based in Russia. And she also did not know that she was taking federal loans into the private sector. And she also didn't know that she could have actually done a income-based repayment plan. And instead of having to pay what she now has to pay is $4,000 a month on her student loans, she could have actually just been paying $1,800 a month with the income-based repayment plan. The true tragedy of this, though, is that she was 3 years away from having her public student loan forgiven. If you have 10 years of working in the government, oftentimes you can actually have all those federal loans forgiven. And now she can't. It doesn't work when you're in the private sector. And so now the other part of it is that she has a house. And in the midst of this, with a $4,000 a month payment, she can no longer refinance to get a lower interest rate if and when rates fall because her debt to income ratio is way too high because of the student loans. And we can't pay them off, we can't get them forgiven. And now she's just plain stuck in a higher interest rate loan with very few options. She's going to be paying on this for at least the next 30 years. Here's what you need to know: there's no turning back. When you go from federal loans to private, you can't take them back the other direction. It's a one time, when you make that decision, that's it. You also can't do an income based repayment plan. That is only available with federal loans. And private loans are not eligible for forgiveness. That's only with federal loans. So if you're trying to purchase a home and you have a debt to income ratio, the only way that we now have of solving that ratio is to pay off debt. And again, first time home buyers often are not in a position to do that. So this creates issues. This is one of the reasons that we actually have been seeing some loans go belly up, and I'll come back to that. So conversation starters. Here's the reality. Like, you don't have to know everything that we're talking about, but this is a way to protect your customers. And this is a way to build good rapport with them because you're looking out for their best interest. And it's also a way to protect future business of yours, which is one of the reasons why we want to cover this. So here's what you need to know. You just need to know that these things exist and then connect your customers with us. That there's income driven options that are based upon where they're at, and it's including how many people are in a family, what their overall costs are, etc. All of that gets taken into account. The save plan. So this is different, and it's put in place because of it's kind of coming in after the CARE Act, and so we want to just cover some of the things that the save plan really put in place to be able to protect people who are paying student loans. And then also the 2023 Fresh Start program that is available for a limited time and is absolutely crucial for some customers who got behind on student loans. All right, so let's jump in here quickly. This is an income-driven repayment payment calculator. Don't try to say that 6 times fast. It's difficult. Now, when you're looking at this, what you can see is we have a payment calculator. You can see that we lowered, so this person can lower their student loan payments by $837, and that's almost $120,000 of increased approval amount on their purchase. So that's huge. It's a really big difference. Now, when you're looking at this and you're like, yeah, this is an example. You can cook these up any way you want. Okay. The reality is that in Independent Mortgage Brokers, my other company, Ryan Davis, the other owner, and I were sitting down to lunch. And then one of our loan officers, who's excellent, has been in the industry for a long time, calls us and says, "Hey, I'm in trouble. I had a pre-approval that we did in September. That buyer got under contract. Now, though, that loan is going to not go through because their student loan payments came in and are way higher than the 0.5% payment calculation that we did in September because that was based on agency guidelines. It's now because they owe so much in student loans, they're paying so much in student loans, debt to income ratios no longer work, and this deal is done. It's not going anywhere." And so in the midst of that, I said, whoa, wait a minute. Did we try to see if we can lower their student loan payments? And so I pointed them back to this because it was relatively new for us. And then we ran it. Guess what? We lowered the student loan payments for this customer by $1,400 a month. This is a real life story. And that deal is closing in 2 weeks. So that's why this makes such a big difference. If you have a customer that has federal student loans, you need to connect them with us so that we can go through this process and make sure that at the very least that we're lowering those monthly payments if at all possible, regardless of whether or not they buy a house. All right, save plan. So here's just the general basics of it. It changed the way people qualify for income-based repayment plans. So what it did was the income-driven payment was reduced from 10% to 5%. So that made a really big difference in terms of like how much they had to pay back. So it reduced how much they have to pay back. And then the income was increased from 150 to 225%. You don't need to remember this. What you need to remember is both ends of the spectrum were broadened so that more people could qualify and so that the impact of it would be bigger. And then there's also a 12-month grace period, but there's a lot of confusion about this. So that grace period does not mean you can choose to not pay your student loans. If you do that, what's going to happen is this. Your credit will be fine because what's happening in that grace period means that it is not going to impact your credit score. However, if you try to purchase a house, you're not going to be able to because those missed payments are counting as missed payments in terms of your ability to get a loan. So it's really important that your customers understand that they need to be paying their student loans. Let's work with them to reduce the payments that they're paying, but by all means, they have to be making those payments. All right, the 2023 Fresh Start program, super important. So what this does is anybody who is delinquent on student loans, so we run into a lot of people that were really confused back in 2019 or 2020 when the pause was put on. And so sometimes, like in some cases, they show as delinquent on their credit reports, when in reality, it all had to do with what happened with COVID. So the 2023 allows all of these people who are listed as delinquent to come current, and basically that delinquency is erased. It also allows them to get those items off of their credit report, which can improve the overall credit score pretty significantly. And then CAVERS, which many people aren't necessarily going to know what CAVERS is, but essentially it's an internal program with the government that gets flagged anytime somebody is delinquent on a federal loan. And when that is flagged, that is a deal killer in your ability to get a loan. So it is really important that we can clear the flags from cavers, that's huge. The other part of this that's incredibly important to know is that your customer only has until September of 2024 to be able to qualify for the Fresh Start program. So this is time sensitive. They need to act on it now. What does this mean for you and your customer? This means that deals that were not going to close because of the new student loan payments, we can get many of those deals to close now. It also means lower monthly payments for your customers. So we, again, lower their anxiety. They can breathe a little more easily. They can afford higher approval ratings on their house. They can get into the house that they actually want to buy. That's massive. And that means that you have happy customers. And you also end up having happy agents because you have a deal that actually closed and you got paid a higher commission check. That's part of what we do. Now, I want to come back to that customer that's like, hey, this is a terrible time to purchase a house. I'm not going to buy a house with a high interest rate. That's stupid. This is what we hear in the media all the time, and I really want to break down the numbers here. So I'm going to show you a slide with a lot of numbers on it, and it might be a little scary, but I'm going to walk you through it. So here we go. Let's take a look at a $350,000 purchase price. So somebody who's kind of getting into that bottom rung of the housing ladder. And let's look at that really scary number that's been on everybody's minds as of late, 8%. This is not where interest rates are at the time of the recording of this video, but it is the number that everybody's been scared of. So let's go 8% just to make this really, really scary. So if we're only looking at the principal and interest payment, we're talking about, homeowners insurance, property taxes, and HOAs and all of that stuff. We're only talking about principal and interest, just to keep it simple and mathematical. In that situation, a $350,000 purchase price with 3% down for a first-time home buyer at 8% interest, that's $2,491 a month. That's the payment. Now, everybody says, I'm going to wait until lower interest rates. So let's just say, hey, rates drop a point and a half. It's now at 6.5. So if you look at the two, there's a decently big difference between these. It's $345 a month. $345 a month for a first-time home buyer who's strapped for cash and now has, student loan payments also being paid. That's a lot of money. And this is what we see all over media, the difference between the payments based on the purchase prices. But they're missing some really significant things. What they're missing is if you're not buying now and assuming you're going to buy at some point, then you are not in a static situation. We're on a timeline. And what happens with the timeline is that things change. It's dynamic. And we have something and that's called appreciation. Now, as we mentioned earlier, the historical average on appreciation is about 4.5% to 5% nationwide. So if we just look at 5% appreciation, then if somebody is buying 1 year from now, then guess what? That $350,000 house is now worth $367,500. That's a $17,500 gain. Now, going back, we all know that the trigger of a lower interest rate means more people are shopping. And so if more people are shopping, there's increased competition. There's going to be a cost to that. It's not just an apples for apples situation of, well, we just got to pay the appreciation. No, we have to win that actual contract. So now let's just say that it costs us an extra $7,500 to win that contract. Now keep in mind, if this value doesn't come in with the appraisal, then we have to pay that $7,500 in an appraisal gap. So that's actually money out of pocket to the customer at the time that they close. So we went from a $350,000 purchase price to a $374,000 purchase price. So what does that mean? Well, at 6.5% interest, because we have a much better interest rate, that is a payment of basically $2,300 a month. Okay, well, you know what? That's definitely less than $2,491. It's actually a savings of $192 a month. So congratulations, you bought a house and you have a lower monthly payment. That's a savings of $2,302 a year. But well, is it really that simple? No, because that waiting cost $25,000 in lost appreciation. And it also meant that we had fewer options because all those people are jumping into the market and that supply got even lower. So it means that we might be buying a house that we don't even like. Oh, and wait a second. We missed 12 principal payments. So that is the amount of when you pay your mortgage, that's the amount that actually is paying down the loan. That's giving you equity in your house. We missed those payments. And now we also missed the tax write-offs. So if you're looking at the actual cost, you're actually looking at something that's closer to a $30,000 difference. But if you actually look at what happens if somebody had purchased, right, the person who purchases now, they made $25,000 essentially in equity, more than that, right? Basically close to 30 when we consider the tax savings and we consider the principal reductions, versus somebody who now is purchasing and spending that extra $30,000. Your difference between those two is somewhere between $55,000 to $60,000. That is a significant difference. And the reality too that people miss is that the person who bought now at 8% interest, that's a really good time to do a refinance. So they do a refinance with no money out of pocket because they can roll the cost of that refinance into the new loan. And now what they do is like they have now lowered their monthly payment by somewhere around $154 a month estimated. And now they're saving $1,850 a year over the person that decided to wait. So when you look at this, who made the smarter decision? It's counterintuitive, but buying when there's less competition in the market. Oh, and by the way, the person who buys now had a higher likelihood of getting seller concessions, which means lower loan costs. Which if you add, let's just say $5, 10, $15,000 that they get in seller concessions to buy now, like that also makes a massive difference. So waiting is not the way to go here. It will actually cost buyers significantly more money if they wait until rates fall and they're shopping at the time when everybody else jumps in the market. So buy now. That's the numbers that are at the basis of it. So that's everything I have. That being said, I can answer tons of questions. I love talking about this stuff all day long, so don't hesitate to reach out to me on this. But yeah, I wanted you to see kind of what's driving the market and what's going behind and why student loans make such a huge impact in it. Thank you very much. I appreciate it. And we'll talk later.